What if I told you that you could own a small piece of Apple, Nike, or even McDonald's for less than the price of a meal? Sounds interesting, right? But how does that actually work? In this video, we're going to break down one of the most talked about things in the world of money, the stock market. No complicated terms, no confusing charts, just a simple, clear explanation of what it is, how it works, and why millions of people around the world pay attention to it. By the end of this video, you'll understand the basic idea behind buying and selling company ownership. And trust me, it's simpler than you think. Let's start with the big question. What is the stock market? Simply put, the stock market is a place, or really a system, where people buy and sell small pieces of companies. Think of it like a marketplace, but instead of buying vegetables or electronics, people are buying ownership in businesses. Now, what exactly is a stock? A stock is a tiny piece of a company. When a company divides itself into thousands or even millions of these tiny pieces and offers them to the public, each piece is called a share. And when you buy a share, you become a part owner of that company. You're a shareholder. Let's make this real with an example. Imagine a company called BrightTech. BrightTech is doing well, growing fast, and needs money to expand. So the company decides to split itself into 1 million equal pieces, 1 million shares. It then offers those shares to the public at $10 each. Anyone who buys a share now owns a tiny fraction of BrightTech. If you buy 100 shares, you've spent $1,000, and you officially own a small part of that company. So how do people actually make money from this? There are two main ways. First, if the company grows and becomes more valuable, the price of its shares goes up. So if BrightTech's share price rises from $10 to $15, your 100 shares are now worth $1,500. You've made a $500 gain just from the company doing well. Second, some companies pay their shareholders a portion of their profits, called a dividend. So even without selling your shares, you can receive regular payments just for being an owner. And why would a company sell its shares in the first place? Because it needs money to grow, to hire people, to build new products. Selling shares to the public is one of the most powerful ways for a company to raise that money quickly. Here's an analogy that might make this click. Imagine your friend opens a pizza shop. The shop costs $10,000 to start, but your friend only has $5,000. So they come to you and say, invest $5,000 and I'll give you 50% ownership. You agree. Now you own half the pizza shop. If the shop does well and becomes worth $20,000, your half is now worth $10,000. You doubled your money. The stock market works on the same idea, just at a much bigger scale, with millions of buyers and sellers and companies worth billions of dollars. Now, here's the honest part. The stock market is not a guaranteed money machine. Share prices go up, but they also go down. If BrightTech has a bad year, its share price might fall. And if you sell during that low point, you could lose money. That's the reality. No promises, no guarantees. The value of shares moves based on how well a company is performing, what's happening in the economy, and even how people feel about the future. This is why understanding what you're investing in always matters, more than just chasing quick profits. So, let's bring it all together. The stock market is a system where people buy and sell ownership in companies. A stock is a share of that ownership. Prices rise and fall based on how companies and the economy perform, and companies use this system to raise money and grow. That's it. That's the core idea. The stock market isn't reserved for the wealthy or the experts. It starts with understanding, and you've just taken that first step. If this video helped you, like and subscribe for more beginner-friendly finance content. And drop a comment below. What topic would you like us to explain next?